Who's going to buy that debt? Once upon a time, the Fed was a big buyer, the biggest buyer of treasuries. Now the Fed is selling. Another big buyer that's not there are Social Security trust funds. Social Security used to be a big buyer of treasuries. Now it's a big seller of treasuries because up until a few years ago, the Social Security program took in more in taxes than it paid out in benefits. Now it's paying out more in benefits than it collects in taxes. So where's the money coming from to make sure the Social Security checks don't bounce? Well, the Social Security trust funds are liquidating their treasuries into the market. So the trust funds are selling treasuries. The Treasury is selling treasuries. The Fed is selling treasuries. You know who else is selling treasuries? The Japanese, the Saudis, the Chinese, the Russians. I mean, they probably sold all of theirs already. But who's buying these treasuries? And if there's no one buying them, the price is going to collapse and yields are going to explode.
In this compelling analysis by renowned economist Peter Schiff, the looming specter of a U.S. debt crisis casts a shadow over the economy. With the national debt soaring past $2 trillion and an $8 trillion balance sheet, Schiff warns of the inevitable consequences of unchecked spending. As the government grapples with record-high consumer credit card debt and inflation on the rise, Schiff predicts a grim future if the Fed continues its inflationary policies. Moreover, he highlights the concerning trend of other countries, including Japan, Saudi Arabia and China, divesting themselves of U.S. debt, exacerbating the predicament. With total consumer indebtedness surpassing $5 trillion for the first time, the American economy faces an unprecedented challenge. Schiff's insights underscore the urgency of addressing the nation's fiscal trajectory before it's too late. Don't miss out on crucial financial analysis like this. Be sure to like, share, subscribe, and turn on post notifications for more updates.
And it's going to get bigger. The Fed is going to pivot. That's the big pivot. It's not about when the Fed is going to cut rates, but when the Fed's going to go back to QE. I think that's coming this year. Even if they don't cut rates, I think they're going back to quantitative easing. Well, if the Fed just gets out in front of it and extends everything, then, but the question is, will the markets react to that? Will they understand what that means, right? That the Fed was just BSing the entire time when it first announced this 1 year loan, that was just a farce. Just like when they first started quantitative easing, Ben Bernanke went to Congress and said he wasn't monetizing the debt because it was just temporary, that the Fed was going to sell back all the government bonds that it had taken onto its balance sheet. Well, here we are, 15 years later, and the balance sheet is much bigger. All the bonds that they bought, they still own, right? Even though they've pared it back $1 trillion or so, in the last year, we're still at close to an $8 trillion balance sheet. And when Powell was talking to Congress about a temporary QE, the balance sheet was barely $1 trillion. So he was lying, and I pointed it out. But the main reason that the Fed is going back to QE is because the alternative, while the correct thing to do, is just politically a non-starter, especially in an election year. We are running $1 trillion deficits, basically a quarter, even though the official national debt is a little under $2 trillion, which in and of itself is a huge number. If you just watch the rate of increase of the national debt itself, because that doesn't lie, there's no phony accounting, that's just the number. Every quarter, the debt is $1 trillion higher than it was at the beginning of the quarter. So the government is selling all these bonds. Over the course of 2024, over 10 trillion of treasuries matures. And now the government has to sell new treasuries to repay the maturing treasuries. So that's, 10 trillion worth of borrowing, 12 trillion worth of borrowing, plus the 4 trillion to finance current spending. Who's going to buy that debt? Once upon a time, the Fed was a big buyer, the biggest buyer of treasuries. Now the Fed is selling. Another big buyer that's not there are Social Security trust funds. Social Security used to be a big buyer of treasuries. Now it's a big seller of treasuries because up until a few years ago, the Social Security program took in more in taxes than it paid out in benefits. Now it's paying out more in benefits than it collects in taxes. So where's the money coming from to make sure the Social Security checks don't bounce. Well, the Social Security trust funds are liquidating their treasuries into the market. So the trust funds are selling treasuries. The Treasury is selling treasuries. The Fed is selling treasuries. You know who else is selling treasuries? The Japanese, the Saudis, the Chinese, the Russians. I mean, they probably sold all of theirs already. But who's buying these treasuries? You know, and if there's no one buying them, the price is going to collapse and yields are going to explode. The Fed's not going to let that happen. The Fed's going to come in and be the buyer, but it can't do that without going back to quantitative easing. And that's what's going to happen sometime this year. The people who have loaned the U.S. government money, they actually think they're going to get paid back. No, they don't realize that they're just giving this money away. They actually think they're loans. And that's because they're not worried about the government's ability to pay, because the government has a printing press and can print all the dollars they want. Well, what they haven't figured out yet is, yes, the government can print all the dollars it wants, but it can't make those dollars buy anything. Mm-hmm. It can't ascribe purchasing power to the dollars. People just take it for granted that no matter how much money we print, you're going to be able to buy stuff with it. No, there is going to be a point where the dollar collapses and you can't buy very much with the dollar. In fact, it's possible that if we continue this indefinitely, that at the end, you won't be able to buy anything with the dollar. It will be completely worthless. Now, you know, we may be able to stop it from getting that bad, but not without a tremendous amount of pain, which would be required to prevent that outcome. But, you know, one of the things that I've been talking about on my podcast about credit, and, you know, last week, consumer credit card debt hit an all-time record high, and total consumer indebtedness hit an all-time record high above $5 trillion for the first time. And remember, these are the same consumers who are on the hook to repay the national debt. These are the only people the American government can tax, and they're broke themselves, right? Mm-hmm. So you can't get blood from a stone, right? So it's all going to be from the printing press. But one of the things that I talked about on my podcast is that once you run up an amount of debt on your credit cards, and you know that you can't pay it back, right? You've already come to that decision, hey, I'm never paying this money back. I'm going to just go bankrupt. Because when you go bankrupt, you just discharge all that debt, right? So once you've made that decision, right, okay, I'm just going to go bankrupt, your incentive between that point and your bankruptcy is to just build up the debt as high as you can.
Sure.
Right? So everything that you buy is free. Once you've made the decision, I owe $50,000, I can never repay it. I'm going to go bankrupt. Well, let me run it up to $60,000, $70,000. Let me borrow as much money as these idiot banks are willing to lend me. Mm-hmm. And then only when I run out of credit, only when I can't get one more credit card, I can't get one more loan, I'm totally out of credit, that's when I go and claim bankruptcy. Mm-hmm. So in the meantime, I'm going to get as much as I can because it's all free. I'm not going to pay. All I have to do is pay the minimum interest payment.
Yeah.
So I can borrow another $10,000. I just got to pay an extra $50 a week, right? Until they shut me down. So I think that's what's happening. I think a lot of Americans are willing to spend. It's not because they're resilient. It's just because it's all free. They don't care anymore what anything costs. I mean, they just want to get it or they need it. And so this is just the end of it. But at some point, you know, these banks are going to cut people off. And the losses are going to be horrific. That's another thing that the lenders are going to lose. They're going to lose on a lot of this credit card debt. We have record credit card debt. At the same time, we have record credit card interest rates. It's like higher interest rates haven't stopped people from borrowing. They keep on borrowing. You know, that's why the Fed isn't winning. One of the reasons, the inflation fight, is inflation is also the expansion of credit. It's not just money, but credit, because credit acts as money. You can buy stuff with credit, and credit keeps expanding. Well, all these loans are going to go bad. Auto loans are going to go bad, right? What about all these people who have bought now to pay later? Who's financing all those things? Mm-hmm. They're never going to pay, right? I always said it was buy now, pay never. That's what was going on. And so all of this consumer credit is going to collapse, and the lenders, you know, the banking system, this is another way they're going to lose. Every time we've had a problem, Congress and Wall Street and everybody have relied on the Fed to solve it.
Mm-hmm.
But the Fed doesn't solve problems. The Fed creates problems. All the problems that we're asking the Fed to solve, it created. And its solutions just make them bigger. But they also numb you to the pain, right? They allow you to kick the can down the road because the Fed doesn't have any magic. All it has is inflation. That's the only thing it can do. So its response to every problem is to create more inflation, to expand the money supply, right? To lower interest rates, to increase credit. And so now inflation has become the problem. People didn't mind inflation in the past because they didn't notice it as much, and because a lot of the inflation was making them richer because it pushed up their stock portfolios, it pushed up their real estate holdings. But now the inflation is showing up more in the supermarket, at the gas station, everywhere. Prices are going up. They're going way up. This is the end result of all the inflation that the Fed has been creating for a decade or more. And it's just getting started. We are experiencing the tip of an inflation iceberg. It's not going back down to 2%. The Fed is delusional if it actually believes this. We're going to see much, much higher rates of inflation in the future than we've experienced in the recent past. And if the Fed tries to bail everybody out again, bail out the banking system from the problems we've been discussing, it's just going to throw gasoline on that inflation fire.
Today's discussion with Peter Schiff has shed light on critical aspects of the U.S. economy and the looming challenges it faces. From the Fed's potential pivot towards quantitative easing to the staggering levels of national debt and consumer credit card debt, Schiff's insights paint a sobering picture of our financial landscape. As other countries divest themselves of U.S. debt and inflation continues to rise, the urgency of addressing these issues becomes ever more pressing. We hope you found today's analysis insightful. Don't forget to subscribe to our channel for more thought-provoking discussions like this video, and share your thoughts in the comments below. Thank you for watching, and see you in the next one.